I'd like to welcome you back. This is Gene Guarino for Cool Trade University. We have a special report for you. Right now, as you know, the market has been going up, up, up. We've been in a major bull market where the market is just continuing to float up, sometimes moving up strong, other times just drifting up. And that's what happens in the market. But what also happens is the market does come down. And that's what we're going to talk about during this special report is what to expect when the market corrects. I'm going to give you some information that I want you to really take to heart. When we talk about being in the market, money management is incredibly important. So as I go through and I give you this input, I want you to really think this through. And we're going to talk about emotions, we're going to talk about stocks, we're going to talk about dollars, but I really want you to get this because this is very important. When the market does correct, when it does move down, how are you going to respond? How are you going to react? With this information, I hope that this gives you some guidelines and some input so that you can handle that correctly. Now, as we go through this information, I just want you to know it's not if, it's when. Not if, but when the market corrects. So what is a correction and market cycles? What are they? Well, first of all, we know the market doesn't go straight up and the market doesn't go straight down. When it's moving up, it moves up and down and up and down. And when it moves down, same type of information. So when we talk about the cycles, we've been in a major upcycle right now. But when we talk about corrections or pullbacks, a pullback might be a very small amount. It might come back a few percent. A correction would be 10%. Now, one of the key points to know is that right now we're at the end of summer of 2013. We have not had a correction in the major indices, that's 10% or more, in about 700 plus days. That's a long time. We are due. So a 10% correction in the Dow would be a 1,500 point down. That's a large move in the market. So a correction, it's not an if, it's a when. When it comes down, how will you respond? How will you react to that? Now, when we talk about a bear market would be a 20% move, a 20% move that lasts for at least a couple of months. So that just gives you a guideline. A pullback, no stock goes straight up. It might pull back a little bit, but a correction would be 10%. 10%. We haven't had one in a long time. It's not if, but when. A bear market would be 20%. 20% over the course of a couple of months, that would be considered a bear market. So I want to lay this out, just make sure we understand it's not if, but when, and how are you going to respond to this. First of all, let's get a definition of what that correction is. A reverse movement, usually negative, of at least 10% in a stock, a bond, a commodity, or an index to adjust for an overvaluation. Corrections are generally temporary price declines interrupting an uptrend in the market or an asset. A correction has a shorter duration than a bear market or a recession, but it can be a precursor to either. So that's exactly what I just said. Figure 10% over the course of time. Now, when we talk about the bear market, a market condition in which the prices of securities are falling and widespread pessimism, notice how we're getting into the emotions of it now, causes the negative sentiment to be self-sustaining. As investors anticipate losses in a bear market and selling continues, pessimism only grows. Although figures can vary, for many, a downturn of 20% or more in multiple broad indices such as the Dow, Standard & Poor's 500, the S&P, or at least over at least a 2-month period is considered an entry into a bear market. Now, we know bear markets can last for years and years and years, but we've been in an uptrend right now. And as I said, we haven't even had a correction for about 2 years now. So it's not if, it's when. Now, we talk about the emotions. We are talking about money. And let's just assume for a moment that you started your account with $100,000. And if you have a correction and it pulls back and now you've got $90,000 in your account, I don't know how that affects you emotionally. Does that upset you? Is that acceptable? Is that the point where you start to say, well, I'm getting a little concerned? Now, if it corrects a little farther, we're into a bear market and it drops another 10%. We're now at $80,000. And at that point, again, what are your emotions and where are you at that point? Now, if it goes beyond that and we're now at $50,000, at this point, you may be at the point where you're disgusted with the whole thing entirely. You've stopped opening up your statements. As a matter of fact, you're saying to yourself, well, I'm just going to close my eyes and go for the ride. It always comes back. Well, the reality, it doesn't always come back. And emotions do rule during this entire process. As a matter of fact, some of you know this. When you buy that stock and you decide this is the stock, this is my entry point, you feel smart when you buy. You'll tell your friends, you'll tell family. You're proud of that because you see that stock maybe moving up at that point. And as it moves up, you've got that feeling of pride, you made a good decision. Then what might happen is it goes down, and nothing goes straight up, it goes up and it goes down. So when it comes down, you might feel a little distressed. Now that comes on lots of different levels, can be described in lots of different ways. If it's just a little pullback, you're not that distressed, but if it does come down 10%, 20%, now you're a little upset, a little distressed. And when I say upset, if there's negative news about your stock or the sector that it's in or the market itself or the economy or what's happening in the US versus the rest of the world, well, at this point you might be very upset because you might be saying, well, I picked that stock and I was proud of my stock, but now they're singling out my stock and negative news is affecting it. So now if it stays flat, maybe it's gone up and then it started to come down and now it's just flat, but you're down 10, 20%. At this point, you might get apathetic, where you're just saying, well, it is what it is. It'll come back. I'm just going to stick with it. I'm a long-term investor. And then it goes up and it goes down and up and down, and it happens in shorter time frames. We now have volatility. And that's very uncomfortable. It's kind of like being in a roller coaster ride without a seatbelt on. So you're going up, you're going down in the market, and maybe you're looking at your statements again and you're getting upset, then you're happy and you're upset and you're happy. And then at some point, some stocks even go so low that they get delisted. They're no longer on the major stock exchanges. And at that point, you're just simply disgusted with the stock. Now, I think if we're honest, all of us have a stock or two in our portfolio that we don't even think about anymore. They upset us so bad. If you have the ability to simply take it off your watch list, so you don't even have to see where it's at, you do that. I mean, I've had stocks like Boston Chicken, remember that? It's now called Boston Market, delisted, no longer there. It upsets you. You get disgusted with it. Some people, unfortunately, get to the point where they just pull out of the market entirely. They get so disgusted. And we think about what happens in the market. The last time the market turned down was just a few short years ago. It was spring of 2009. When the major indices hit a very big bottom. And when it hit that bottom, there was a lot of people that just simply said, that's it, I'm disgusted, I'm out. And they sold and they went to cash. Now that's exactly what happens in a market. That's called capitulation, where the last few holdouts are just so disgusted they just say, I'm out. And you can see it in the charts so clearly. But when they're out, they're selling at the absolute bottom. So now they're sitting in cash, money is in the bank, earning 1/4% maybe, and they're sitting there saying, I'm mad at the stock market. It's a bad place to be. So they're out of the game. They're not making money in the market. They're in cash. And then the market at some point starts to move back up. And they say, well, I'm mad at the market, so I'm just going to stay here in cash. And then it continues to move up. And now it's up 10%, 20% off the bottom. And at that point, their disgust turns to, well, I should have stayed in. So now they're mad at themselves. So they're mad at themselves and they're going through this gamut of emotions, and then as it goes up farther, they say, well, I should have gotten back in, but I should have done it 2 months ago, and then 6 months ago, and then a year ago. And then what happens is, here we are now 4 years later, 2013, where the markets are pushing all-time highs in the S&P, in the Dow, and people are just now looking at the market saying, you know what? I should have stayed in, but now the market is up so big, I better get back in. And when they get in, it's at the high, not at the low. Instead of sticking it out and riding it back up, they got out at the low and now they're about to get back in at the high. Now, what I just described to you is probably the worst case scenario, but some of you can relate to what I just said. Some of you, I just explained the last 4 years of your investing career. On the other hand, some of you wrote it all the way down to March of 2009. You simply didn't open the statements anymore. You just said, I'm going to stick with it. And now the stock and the market is back, and now you're saying, what should I do? I mean, I've got the money back that I had 4 years ago, but what should I do at this point? Will it continue to go up or will it come down? So all these emotions, as long as we understand that the emotions rule, we need to really take a look at this. And I want you to understand what you're seeing on Cool Trade. When you pull up that Cool Trade screen, you see a lot of different things, but what I really want to focus on right now during this segment is the columns that are labeled today's P&L. Now, P&L stands for profit and loss. Today means what's happening in the market today. So whatever day it is, if it's a Thursday, this Thursday in the market right now, where is the stock that I own at this moment in time when we talk about profit and loss? Then there's another column right next to it. It says net P&L. Now that means not just today, but maybe you've held the stock for a week or a month or months and months and months. So where is that stock in relationship to where you entered the trade? Where is it today? So the net P&L is positive or negative, but remember the way Cool Trader works is when you use Cool Trade properly and the stock goes up, it's going to lock in those profits. So you're probably not going to have a positive number, a green number there on the net P&L, or blue, and that's the way you'll see it on the screen. It's probably going to be red. So I need you to understand exactly what it is that you're seeing, and we need to tie it into the report. Now the report can be pulled down from the top because that is all the closed trades. Because if you just look at your screen, and I put one up here on the screen so that you can see, I've circled the net P&L and today's P&L. So again, when you look at that, the numbers are red. Well, think that through for a minute. If there was profit, Cool Trade would have already locked in the profit, closed out the trades before it went back down. That's what it's designed to do. So chances are it's going to be red most of the time. Now, when you look at the screen right there, it says net P&L is minus $168. I don't think that's a problem for anyone that I'm talking to right now, $168. But let me put this next one on the screen. This isn't one of my screenshots. This is one from Ed. That one says minus $52,900. Now that may cause some problems for a lot of us listening. 52,000 negative. But right next to it, it says today's P&L is up 56,000. So that means before that day in the market, whatever day that was, before that day in the market, it was actually down, what, $108,000, $109,000. Now obviously he's got a lot more zeros in the account, but I want you to get the feel for it. Just because the net P&L is negative isn't a bad thing, because there's one more piece to what I just described. You have to look at the report. And when you pull down the report, it's a listing of all the closed trades. Now again, Cool Trade is designed to close trades with a profit. So you should have a series of trades. It could be dozens, could be hundreds of trades, but a series of trades that have closed for a profit. And at the bottom, there's going to be a total. And if that total says $20,000 of profit from all of the trades that you've done this year, but your net P&L says negative $5,000, well, think it through. I've pulled out $20,000, but the current positions that I own are minus $5,000, which means if I sold everything at this moment in time, I've got a $5,000 loss, but I've already taken $20,000 in profit out of the market, which means net, we've got $15,000 in profit. So it's very important that you understand what you're seeing on the screen and exactly what it means. A lot of people who don't understand what I just said will look at their Cool Trade screen and says, it's red, it's negative, that's not good. No, the reality, just because the screen is red or negative, that doesn't mean it's a bad thing. It just means you need to understand what's happening at that moment. So today's P&L is exactly where that stock is in this trading day. The net P&L is the positions that you own, where you entered them and where they are today. Again, it's probably going to be red because if it's a blue number, the positive, we don't use green there, we use blue for that highlight. If it was blue or positive, it's going to lock in that profit. It's going to now be on the report. So we need to look at all those things together to review. Today's P&L is what's happening in the market today. The net P&L is exactly what positions you own, where you entered and where the price is at this moment in time. The report shows all the booked trades. So we need to look at all of those in combination.